I'm concerned that the failure of Silicon Valley Bank is going to have repercussions that can be hugely negative for the economy and can also start sort of a daisy chain of additional bank failures. In this video, we're not only going to talk about the economic impact, which we're just starting to see, but also another large, potentially insolvent bank that has been selling off significantly as well. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. So let's understand, well, what's going on here. So you see Etsy, this is the, people selling their goods, their tchotchkes market, has something like 7.5 million sellers on their platform. They're announcing that they're delaying the process of paying the deposits for their sellers because of the Silicon Valley Bank collapse. And this is just one example. When you have a bank all of a sudden stop working, and it's a sizable bank, $100 billion plus in assets, lots of deposits, these Etsy sellers, they're going to say, man, I needed that money. This is catastrophic for me. And that's what some of them are saying. I need that money to make, a payment for this inventory. What you're seeing with the Silicon Valley, the folks that have their deposits there, there's a lot of businesses that are worried that they may not be able to make payroll. And then if folks aren't getting payroll, then people aren't making their mortgages. So you see how this quickly spirals into a really ugly snafu for the economy. So that needs to be understood, is that if it's not stopped very quickly with either bank, Wall Street intervention or government intervention, you quickly can see a depression. That's part of the reason why I have a picture of Andrew Mellon over my shoulder, the Treasury Secretary over during the Great Depression. Is arguably he's part of the reason why it became a Great Depression. So I last did a video talking about Charles Schwab, Wells Fargo, and First Republic because those were, I think, the top three banks that people were asking me about. And there are also sizable banks that have sold off. What Wells Fargo sort of held up on Friday, but broadly, all of them have sold off in response to the fears, with Silicon Valley Bank being seized. Now, the conclusion from my video was that, look, they all had big holes in their balance sheets, billions of dollars, because interest rates have risen, not necessarily because they were, making really speculative bets, but because they had reached for yield, making loans or buying debt that had 5 to 10 year maturities. And as interest rates move up, the value of that portfolio dropped. So they all had these billion-dollar holes. But broadly speaking, looking at it, and as I think more and reflect on it, Wells Fargo's, in the too big to fail camp, $2 trillion of assets. So I don't think you're going to see, that the outflow of depositors. If anything, you might see an inflow of depositors from this. They could benefit from this environment as people just go, I'd rather, even if I don't get anything for my cash, and I personally keep my investments at Interactive Brokers where I get 4% on my cash, but Wells Fargo, you go, hey, I might get 0, but I don't have to worry about this risk because it's too big to fail. It's one of the top banks out there. So you have that aspect, even though it's not a super clean bank. You do have, tens of billions of dollars in terms of a whole, but they can absorb it over time. Charles Schwab, the next one up here, Charles Schwab, that does have a bank component in it, and they have $500 billion of assets. The challenge is, looking at Charles Schwab in total, the challenge is I think Charles Schwab has really poorly managed their balance sheet, especially relative to like Wells Fargo, and their whole, in terms of the loss from their investments, going down, this bond portfolio going down because of higher interest rates, relative to their equity is really ugly. Now, I don't know exactly how that plays out, but it doesn't make me comfortable at all. So from a buying perspective, I wouldn't be comfortable buying Charles Schwab stock. And I'm very happy having my investment accounts at Interactive Brokers once again. Regarding First Republic, I said, look, there was this hole, and with each of these, I said, there's a hole, a sizable hole, but they could probably absorb it unless there's something else that I'd want to, learn about, unless there's another concern that develops. And that's where I spent a little bit more time today reflecting on First Republic, and I came across something that made me realize it's actually potentially much worse than I initially expected. Now, first of all, in full disclosure, this is not financial advice. Now, when I previously talked about First Republic, I was just focusing on their bond portfolio because it was the bond portfolios that got Silicon Valley Bank in trouble, and arguably it's a sizable loss for Charles Schwab and Wells Fargo as well. The investment bond portfolios where they say, hey, previously it was available for sale. Now, because the losses are so big, we're going to mark it as held to maturity. So we're just going to say, we're just going to hold this to maturity unless someone forces us to sell it because there's so many redemptions from our depositors. So that's sort of the dynamic that you're looking at here, where there's this $5 billion loss in mark to market because of their municipal security. So not necessarily a big risk from a principal repayment, but just because interest rates are higher, these are worth less. Not worthless, worth less in a higher interest rate environment. So that's a $5 billion hole relative to what they're marking at, $23.5 billion versus $28 billion. The next big component, and this is the thing, that as I did more research, made me much more concerned regarding First Republic, is looking at their loan portfolio. Originally, I thought, hey, this loan portfolio, it seems, like they have great underwriting, which they do, and we'll talk about that in a second. The problem is that, a lot of it's fixed rate, and when you mark their loan book, the loans that they made to market, and you say, hey, what are these loans worth? In a fair market value, well, they're carrying them, for example, their real estate secured mortgages, they're carrying them at $136.8 billion. But they're saying the fair value, because interest rates are higher, would really only be closer to $118 billion. So when you look at the real estate secured mortgages and other loans combined, you're looking at a $22 billion hole. That's in addition to that $5 billion hole that I was previously talking about with their bond portfolio, the stuff that they've invested in. Now, once again, you look at their underwriting standards, seems really rock solid. For example, single family real estate secured loans, that's nearly 60% of their total loan portfolio. They were underwriting these things at 59% loan to value. These are secure loans. The problem, and it's around $1 million outstanding loans, primarily California loans. You can look at their charge-off ratios, over many, many years here, for the most part, extremely sound loans. The problem, once again, is that a lot of folks were thinking, okay, well, wait a second, what happens in an environment where they just forgot, or they didn't think through? They weren't considering what happens if we have to raise rates significantly within a couple of years. And what you're seeing here isn't even the impact of a recession, which you could now have because of these secondary effects. What you're seeing here is the mark-to-market risk that, look, we were, let's say, underwriting, mortgages at 3-4%. Now it's closer to 6-7%. That's going to be a loss for us. And that is the secondary effect. This is the example of the Federal Reserve breaking something where you start sort of seeing these banks go, uh-oh, spaghetti go, we're insolvent. And that's the challenge that you're seeing here, because you now have a $27 billion hole with First Republic versus only around $14 billion in equity. So let me make sure this is crystal clear to you. This makes them look like they're insolvent. First Republic, FRC, I believe is the ticker. It makes it look like they're insolvent. Now, the flip side is, and Warren Buffett, he's talked about this in his annual letters going back several decades ago, is it's possible you have companies that are insolvent and they continue to be, they continue to be in business for years and years and years because there's no sort of catalyst that forces them to go out of business. So just because, you have arguably negative equity, like what you see here with First Republic, with them marking their loan book to what, would be fair value, resulting in negative equity, you could just sort of, as long as there's no catalyst that forces you to realize these losses, then you can stay in business. And that's always where this concern of like, well, wait a second, could there be a bank run that catalyzes this concern? Now, First Republic's first, very quick to point out, like, look, our deposit base really diversified, and we have $60 billion of borrowing power against our loan book. So that, that sort of way of saying like, look, even if there's $60 billion worth of deposit withdrawals, we'll be fine to cover it. That's sort of the dance that speculators are playing if you're looking at First Republic stock, or if you're just worried about how the situation plays out. If you're a depositor even, is like, will people pull that $60 billion? And for context, like, I believe the last day on Silicon Valley Bank was open, there was something like a request for $40 billion worth of deposits. People were requesting to pull it. So that is the concern of, could you see that sort of, It's a Wonderful Life type of bank run type of concern? Could you see that start to play out with First Republic? And once again, this is the key aspect when you consider businesses. You can have insolvency for some time. You can have bad assets, but it's going to require that impact from the deposits where people are looking to pull them in order to see a real problem for sort of develop that breaks a bank. And this is why it's concerning when you see people start tweeting like, look, here's the line for people looking to pull their money at the First Republic ATM machine. And that's the thing that starts getting psychology going, saying, oh my goodness, this is a modern day run on the bank. And this is potentially a daisy chain where you start seeing multiple banks implode. And then you start seeing a real impact on the economy, So what's going to happen to the depositors if, let's say, First Republic gets seized? What's going to happen to the economy? Well, first of all, as you look at these different parts, like here, I'm going to talk about First Republic and the deposit recovery in just a second. But look, it's important, in my opinion, in this time, to try to keep your head, on your shoulders, try to stay sane when everyone else around you is going crazy. And there are going to be some people panicking, definitely in this environment. And so I think you look at this and you're trying to find things that no matter what are going to survive. When I see companies that have insolvency risk or huge blow-up risk, it's just too hard for me. I would rather find something that has a multi-decade history, that has proven that they're not taking speculative risks and that they've nailed it recently. That as interest rates have moved higher, they didn't overreach and didn't put themselves in a position to rely on the kindness of strangers. That's my concern here with something like First Republic, or even potentially Charles Schwab at some point. There would have to be something else that would get them in trouble. And so, I look at this and I'm thinking, we're clearly going to see a huge, kick in the pants to the economy because of this, with businesses, payrolls, individuals, potential mortgages. So you are going to see, I would expect, delinquencies, foreclosures, all the nasty stuff pick up because of this economic impact, because when you start seeing banks and credit just being seized. So that, having that model of, if you don't nip this in the bud right away, you can see a really nasty, ugly recession pickup, potentially depression type of scenario pickup. And once again, there's a reason why reading Mellon was so valuable to me personally, is the Great Depression didn't have to happen if you had bankers step in and say, if you had the government step in and say, hey, we're not going to let this just run like a wildfire. So it's really important to understand that development. Now, looking at, will depositors recover, talking about that $27 billion net of their assets, something like a $27 billion hole, net that out. And, so your adjusted assets are maybe around 185 billion. This is what I think a strategic buyer for First Republic would think. They'd say, okay, fair market, let's mark down these assets a bit, versus deposits of, let's say, 176 billion. It's clearly a lot lower now because, they've been selling some of their, they've been going through their cash to, deal with what appears to be, a lot of people requesting their deposits, their cash back. But overall, based as of 12/31, 2022, it would seem like you would need to have another 5% haircut beyond the holes in the balance sheet to get me concerned that depositors wouldn't receive 100 cents on the dollar. You would need to see another 5% haircut. Now, that could happen. You could have another, there could be that's the problem where this starts spiraling into itself, is if it's left unchecked. And then, people start not paying their mortgages. But at this point, I think the depositors are made whole in this case, because keep in mind, when you have a shutdown like this, or a bank is seized, the equity gets wiped out, and then the bonds get wiped out. So it's really, you got to make sure it's the bonds only recover something after the depositors get paid in full, generally. And so that's what you're looking at here. So I would suspect depositors, even if people are getting nervous, even if it gets seized and you're not able to pull it out in time, that type of situation, I would suspect you're still made whole. It's a question still similar to Silicon Valley Bank of how long until you get repaid. But I look at this environment and I'm thinking, this is really unfortunate that we're looking at the secondary effects of the Federal Reserve having to tighten in response to inflation being too high. And you're just starting to see, okay, what are the things that are breaking here? And you see not even situations where they were making really egregious speculative asset investments. No, what it was is they were reaching too far, and they weren't sort of watching their back for what happens if interest rates move higher, and they weren't thinking ahead. And once again, I prefer to align myself with the folks like Warren Buffett, Berkshire Hathaway, where he, instead of reaching for yield and putting his $100 billion in cash in 10-year bonds, he said, hey, I'd rather get a lower yield and keep it in cash. And so that's what I'm focused on. I'm looking for companies like that can manage themselves well. And I call out those types of companies at unrivaledinvesting.com. I hope this video has been helpful for you, talking about how, unfortunately, it looks like, a huge potential impact for the economy. As you look at, startups, the folks that had the deposits at Silicon Valley Bank hurt. You're looking at potential secondary effects at companies like Etsy having trouble, making sure the deposits are in time for their sellers. And now you're looking at another bank that, unfortunately, because of higher interest rates, looks like it's insolvent, but we'll see how it plays out. We'll see if sort of the deposit base is stable. And that's the very challenging part about this environment, is it's a fog partly dependent on animal spirits. How reactive will people be to pulling their funds, or will they just say, it's going to be okay, I'll still get 100 cents on the dollar potentially? So that's really the environment that we're in. Now is the time to be looking for things that you can hold ideally, and ideally not blow up for multi-year, that's multi-year potential gains. This is the environment you're looking in this fog to look for these types of bargains. I call out what I think are compelling at unrivaledinvesting.com. I hope this video has been helpful for you. Thanks so much for tuning in.